Over the last 12 months, gold is up 65%, Bitcoin is down 30%. And the most popular Bitcoin stock on the market just quietly abandoned the one promise that justified its price. Almost nobody noticed. This is the map of where tech and crypto actually stand right now, not the hype, the evidence. This is the Asymmetric, Issue 0, the map, tech and crypto for thoughtful investors, written from an operator's lens. First, what this is and what it isn't. This is institutional discipline in plain language, sourced claims, stated confidence, and a clear view we are willing to be wrong about. It is not stock tips, not hype, and not pretending we can predict the future. When we are wrong, we'll say so. You'll see the same labels on every page. Confidence, high, medium, or low. Consensus versus variant, which is what the market believes and where we may disagree. And on every call, what would change our mind? That's the whole discipline. Part 1, the regime, where we actually are. The headline says the Federal Reserve is tight, holding rates between 3.5% and 3.75%. But look closer. Since December, the Fed has quietly been buying short-term Treasury bills to keep bank reserves ample. That's liquidity expansion under another name. Tight on rates, quietly easing on liquidity. So here's the net read. Late cycle, with liquidity quietly expanding, inflation sticky but not breaking out, and a real geopolitical risk in the background. This regime rewards quality companies with real cash flow, genuine infrastructure, and pricing power. It punishes balance sheet stories and unprofitable growth. Part 2, what's moving? 6 questions we use to read the tape right now. First, artificial intelligence spending. The 4 largest cloud companies will spend roughly $700 billion this year, nearly double last year. The cycle isn't peaking, it's accelerating. The real question has shifted from whether the spending arrives to whether it earns a return. And the market has started to notice the difference. When Google raised its spending, the stock went up because it could show the revenue. When Meta raised its spending, the stock fell 6%. Reflexive cheering is over. Now you have to show the money. Second, gold versus Bitcoin. Over the last 12 months, gold is up 65% while Bitcoin is down 30%. Year to date, gold is roughly flat and Bitcoin is down about 20%. The correlation between the two has collapsed to its lowest since the 2022 bear market. Gold won the trade, Bitcoin won the narrative, which damages the digital gold thesis. In practice, Bitcoin has been trading like high-beta technology, not like a safe haven. Its correlation now runs with the Nasdaq, not with gold, for a portfolio that changes the role it can actually play. Third, liquidity. The inflection has quietly already started. Treasury bill buying, heavy bill issuance, and a draining overnight facility are all pushing dollars back toward risk. We are not in a melt-up yet. We are in the floor-building phase. Position for the next 12 months, not the next 12 days. Fourth, the power behind artificial intelligence. Constellation is now the largest private power producer in the country. Vistra is buying gas plants and signing 20-year deals. GE Vernova booked more data center equipment orders in a single quarter than in all of last year. The contracts land in 2026. The earnings arrive around 2028. And there's a regulatory fight worth watching. The cloud giants want to build power right next to their data centers, bypassing the grid. The utilities want to stop them. However the regulator rules, it reshapes returns across the entire power sector. Fifth, stablecoins, the most underappreciated story in crypto. The market has crossed $322 billion and moved $28 trillion in a single quarter, roughly 3 times Visa. This isn't speculation. It's the plumbing for digital dollars, and it's being built right now. Sixth, the debasement trade. Gold won it, Bitcoin won the story. Both can be true. But if you bought Bitcoin as a hedge against money printing, 2026 has been a hard lesson. Gold did the job. Bitcoin behaved like a risk asset. Part 3, the deep dive. One company, strategy, the firm most people still call MicroStrategy. Our stance, watchlist, high risk, and not a core holding. Here's the one-sentence thesis. Strategy is a leveraged Bitcoin vehicle whose premium has compressed to almost nothing at the exact moment management abandoned its never-sell promise. The upside now needs two things to go right. The downside only needs one to go wrong. The business is really two businesses: a declining software company that barely matters and the largest corporate Bitcoin holding in the world, over 800,000 coins. The Bitcoin is the entire story. Everything else is rounding error. The engine works like this. Issue stock at a premium to the Bitcoin it holds, use the cash to buy more Bitcoin, grow Bitcoin per share, and repeat. But it only works at a premium, and right now that premium has compressed to almost nothing. At parity, issuing stock buys Bitcoin 141. The flywheel stops turning. Here's where we differ from the crowd. The consensus sees a leveraged Bitcoin bet with a permanent premium. We think the flywheel is breaking and that the market hasn't repriced it yet. On the last earnings call, management ended its never-sell policy. That promise was the foundation of the premium. Quietly, it's gone. Run the scenarios. In our bear case, a 35% probability, the stock falls 40 to 60%. The base case, 45%, is roughly flat. The bull case needs a new Bitcoin mania to return. These are judgment calls, not guarantees, but the risk is skewed to the downside. Now the strongest case against us and against the stock. This is late-stage leverage starting to work in reverse. Bitcoin down 40% from its peak, the premium gone, management shifting under pressure. The bulls answer with, the founder will figure it out. That's faith, not analysis. For simple Bitcoin exposure, a spot exchange-traded fund is the cleaner vehicle. So what would change our mind? A premium that re-expands and holds. Bitcoin reclaiming $100,000. Real discipline in how management allocates capital, and genuine accretion, not just optical growth in Bitcoin per share. We are watching all four. For the next 30 days, watch 5 things. The Federal Reserve meeting in June. Strategy's premium to its Bitcoin. The regulators ruling on power colocation. The stablecoin market cap. And Nvidia's earnings, the cleanest read on whether all that spending is converting into chips. So where do we land? On the macro, cautiously constructive. On artificial intelligence infrastructure, constructive, but quality matters more than ever. On crypto, mixed. Yes to stablecoins, no to Bitcoin as digital gold. And on strategy specifically, watchlist and avoid as a core holding. One last thing, this is research, not personalized financial advice. Every claim here is sourced, every assumption is on the table, and all of it should be independently verified. We'll be wrong sometimes, and we'll tell you when we are. That's the map. The Asymmetric turns filings, flows, and market data into one disciplined read for investors who want the evidence, not the noise. If that's your kind of edge, subscribe. We'll see you in the next issue.